The biggest U.S. bank collapse just went down, and it's sending shockwaves throughout the economy. What does this mean for us? Are we headed for a total recession? On March 10, 2023, California-based Silicon Valley Bank, SVB, was slammed shut by state regulators after a massive drop in deposits. And if that wasn't enough, Swiss bank Credit Suisse took a massive hit just 5 days later when its biggest investor refused to give it more cash, causing its share price to plummet by a staggering 24%. With all these major players in the banking industry collapsing, it's pretty clear that a banking crisis is already in full swing. But how did we get here? And what does it mean for the future of the economy? Well, it all comes down to one crucial event: the collapse of the Silicon Valley Bank. This state-chartered commercial bank was a major player in California, and in fact, it was the largest bank in the world's premier technology and innovation hub, Silicon Valley. SVB was the go-to bank for tech startups and venture capital firms, as well as clients in fields like life science and healthcare. Some of the big names that SVB worked with include Roku, Roblox, and Vox Media. But when SVB crumbled, it set off a chain reaction that has rocked the banking industry, not just in the United States, but around the globe. So, what exactly went down at SVB, and what impact has it had on the rest of us? The tech industry has seen some major highs and lows in recent years, with Silicon Valley experiencing both incredible growth and sudden downturns. Unfortunately, this has had a huge impact on the Silicon Valley Bank, which was once riding high with around $100 billion in deposits. But with interest rates at record lows, things were already looking shaky. When SVB invested billions in long-term U.S. Treasury bonds, they thought they were making a safe bet. After all, these bonds are backed by the government. So what could go wrong? Well, as it turns out, a lot. When interest rates began to rise, these bonds lost value fast, and SVB found itself in a precarious position. To make matters worse, the entire tech industry was starting to experience a downward trend, with companies withdrawing their deposits left and right. This led to a classic bank run, with panic spreading like wildfire and everyone scrambling to get their money out. It's safe to say that things were looking pretty bleak for SVB at this point. The situation at SVB quickly went from bad to worse as clients continued to withdraw their money in droves. In order to pay back those who were leaving, SVB was forced to sell off a large portion of its bond holdings at a loss of a staggering $1.8 billion. This went from worse to dire as other investors and clients became nervous about the bank's stability and began to pull out even more money in a panic. Incredibly, on the day before the bank finally collapsed, clients withdrew a jaw-dropping $42 billion in a single day. With these massive losses and panicked withdrawals, it's no surprise that SVB's share value plummeted a whopping 60% in just a few short days. This wiped out an astonishing $80 billion in value from the bank's shares. The collapse of SVB truly was a catastrophic event, and its impact on the rest of the financial world cannot be overstated. What exactly caused SVB to collapse? There isn't one single reason to point to in regard to SVB's collapse. The pandemic wreaked havoc on the economy, and the stimulus checks contributed to a substantial inflation problem. This led the Federal Reserve to increase interest rates in an attempt to fight rising prices. In a nutshell, higher rates make loans more expensive, which in turn softens consumer demand and helps stabilize prices. As a result, the SVB's investments in long-term U.S. Treasury bonds from 2020 to 2021 weren't doing so well with now much higher interest rates. But that's not all. The blame game is on, and politics is taking the heat as well. Senator Bernie Sanders accused former President Donald Trump and Congress of undoing some of the credit requirements imposed under the Dodd-Frank banking legislation brought in after the 2008 banking crisis. These requirements were designed to protect banks like SVB from collapse, but without them, SVB was left vulnerable. And if that wasn't bad enough, SVB lacked a crucial chief risk officer for some parts of 2022, which could have helped identify and mitigate investment risks. Did SVB intentionally keep this position vacant to hide something? Or was it just a massive failure of risk management? The speculations are running wild, with shareholder lawsuit specialist Reed Catherine suggesting foul play, and Danny Moses, an investor who predicted the 2008 financial crisis, calling it complete and utter bad risk management on the part of SVB. It's actually a combination of all these factors that affected the brink of collapse in the banking sector. But what steps are the federal government going to do next to stop a bank run? When the SVB was officially closed down by the California Department of Financial Protection and Innovation on March 10, 2023, the FDIC was declared the appointed receiver. If you didn't know, the Federal Deposit Insurance Corporation, or FDIC, acts as your personal insurance policy, the same way you have insurance on your car and your house if something bad happens. FDIC insures your money in a bank. Unfortunately, they only insure up to $250,000 per account. So what happens to those tech startups who have payroll, aka employees to pay, and have millions saved in those accounts? Well, if the Fed didn't get involved, that money would have simply vanished, or at least delayed in issuing a portion of that cash to those accounts. It would have been really ugly, and people's livelihoods would have been at stake. But alas, the federal government came in like a white knight and took care of its people. The FDIC created a new, full-service, FDIC-operated bridge bank in order for SVB clients to still access their accounts. According to their joint press release, after receiving a recommendation from the boards of the FDIC and the Federal Reserve and consulting with the President, Secretary Yellen approved actions enabling the FDIC to complete its resolution of Silicon Valley Bank, Santa Clara, California, in a manner that fully protects all depositors. Depositors will have access to all of their money starting Monday, March 13th. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. This save allowed clients to perform normal banking activities, including online banking, and can access their money through ATMs, debit cards, and writing checks as before. A bridge bank is a chartered national bank that operates under a board appointed by the FDIC. It assumes the deposits and certain other liabilities, and purchases certain assets of a failed bank. The bridge bank structure is designed to bridge the gap between the failure of a bank and the time when the FDIC can stabilize the institution and implement an orderly resolution. While the FDIC does protect SVB's depositors and ensures that none of their money will be lost, the same cannot be said for SVB's shareholders and debt holders. At the end of their joint statement, the three bodies assure the public that the U.S. banking system remains solid thanks to the reforms made after the 2008 financial crisis. However, how true is all of that? Is the U.S. banking system truly remaining solid despite this ginormous shock to the system? The collapse of SVB is sending shockwaves throughout the entire banking industry. While SVB was saved, it cascaded a domino effect in the financial sector. In fact, according to a study published by the Social Science Research Network, around 186 banks across the United States could fail if around half of their depositors withdrew their money too quickly, like what happened with SVB. We've already seen 3 significant banks collapse in a span of 3 days. SVB, Silvergate Capital, which had gone into voluntary liquidation after racking up $1 billion in losses in the past quarter, with its shares down by 67%, and Signature Bank. This entire banking crisis is a huge economic risk and can make a recession more likely.